Welcome, everybody. I see we have a couple of people already here. We're going to wait for a couple more people to come on. Let me know if you can hear me. I'm going to drop mine and Kyla's information into the chat so that you guys can reach out privately to us if you have any questions after the Zoom tonight. So let's get started.
I'm just trying to get my camera on. I don't know where my option is. Don't know what I just did. Hold on. Sorry, guys.
So tonight, as we already had said, I'm going to put everything in the chat. Also, we will be talking about, first of all, how you can get a personal residence with an FHA loan and how you can make money from that as well, and how you can get other people to cover your mortgage. This is how we're going to start. That's a very easy beginning way of starting to make some passive income in real estate. Then we're also going to be talking about Dscr loans. We're going to be talking about Airbnb investing and about the Brrrr strategy, which is all strategies that Kyla and I are using.
Hi, can you see me?
Yes, we can see you.
Okay, something happened and it wasn't giving me the options to allow video. Can you hear me okay?
Yes.
Okay, good. Sorry about that. Yeah, I was like, where did the option go? It was just gone, so I had to leave and come back. So I guess we should get started. It's right 8:31 now, but I don't want to hold people up. So do you want to just jump into things?
Yes, let's get started. So with what I just touched on, it's called house hacking, or that's in the investor community what we call it. That's when you're purchasing, it doesn't have to be a duplex or a triplex or a fourplex, because it can't be no more than a fourplex, but it can be. It's obviously easier, but you could also do this with a single family home. That's when you purchase a home with an FHA loan. It doesn't have to be an FHA loan though, but it's obviously the easiest way and they're usually the lowest cost way, but Kyla's the expert with that. So that's the way. So what you will do is you'll be purchasing a home and then you'll be either renting out rooms to other people, or you will be renting out, if it's a duplex, obviously you have a whole different unit in the house that you purchased. And that's how you will hopefully cover all or most of your mortgage. So that's a really great way.
With that particular, sorry to cut you off, Steph. That particular strategy, keep in mind, we're just doing this at the beginning piece. We're going to get more into strictly investor, information and facts. With the FHA, scenario that she's speaking on, obviously that applies to those of you who are not yet homeowners, who do not yet own property. You don't have to own property to purchase as an investor, but you do need to own, you don't have to own property to purchase as an investor. However, you cannot purchase with an FHA loan product if you already own property, unless of course it made sense. But in this scenario that we're speaking on, we're talking about 2+ unit properties. In that sense, you purchased with an FHA loan. You would purchase it as primary because you're occupying one of the units, and then you would rent the other units out. So that is the best way to get started as an investor, especially if you don't have, large down payment. It's minimum payment down because you're purchasing as primary. So that's 3.5% with an FHA loan product. So you're able to get into a home as a primary buyer, which is obviously better interest rates, lower down payment, and then you're renting out your other units, which offsets your debt to income ratio, obviously helps you to pay your mortgage. And now you have an investment property that's also your primary. And then from there, it's very easy to move on to, say, a single family home and also purchase as primary and utilize that. And now you have an investment property there. And with that investment property, what's great about having investment properties and building a portfolio, as Stefanie knows, over time, when you build equity in these properties, you can tap into that equity. If you ever need capital to purchase more real estate, you're able to tap into the equity on your properties that you already own. I always tell people, if you're going to tap into the equity of your home, only use it to purchase more real estate. Don't use it to go on vacation and do, buy a Gucci bag. Like that's never a good idea. Always use any funds from a property to purchase more property, to build more wealth. That would be the only smart way to do it. So let's move on, Stefanie, to I know you wanted to speak on some Airbnb stuff.
I wanted to ask you a couple of things first, because I know people are always really, really interested on the topic of the FHA. What is the minimum required from them? How does that process look? Because I know that a lot of people are interested in that and they kind of hear that word FHA thrown around a lot and they don't really know what it means. So I wanted to see if you can touch on that and explain a little bit more. I know we're doing a loan right now for somebody and she will end up not having to pay anything down. She will only have to pay her closing costs. So I know that people are really interested in that.
Yeah, so that is the 100% financing product, which we have a number of lenders that offer this product. There's two different ways the lenders do it. They do have one option where there is loan forgiveness after 10 years. So it basically sits on your title as a second mortgage, but it has no payments are required. And after 10 years, it's forgiven. So you're supposed to occupy the property for 10 years and you can't sell, you can't refinance in order for that to be forgiven. 100% forgiven, meaning you don't have to pay it back. There's also the other option where they do a second mortgage that does have a small payment for that 3.5% down payment. So FHA requires 3.5%. So what they do is they do like a piggyback second mortgage. The interest rate is 2% higher than on your first mortgage. And I will tell you the first mortgage rates are not the same as if you were putting down the 3.5% yourself. So I always tell people, and my partner Marcio, who's actually on this call, hi Marcio, he always says there's no free ride. Like we always tell people that. I know like people, hope that everything is free, but it's not. These lenders don't give us anything for free. There are great programs, but nothing's for free. So if you do 100% financing program, know that, the rates are usually about 2% higher. So if you could get, say, a 5.5% rate, if you put the 3.5% down, but you're like, hey, I don't have the 3.5%, but I really wanted to get into this home and get started. And that's great. And I totally encourage that. However, just know that, you may be quoted a rate in the 7% range. And, you hear about your friend that's getting a rate in the 5% range. Well, that's why. But like I said, it's a great product for people who don't have the capital, they have not yet earned the capital. And if you purchase with 100% financing in order to obtain a property that you own versus paying rent and paying somebody else's mortgage, then 100% go for it. And over time, as you build equity in your home, you'll then have that wealth or that capital to tap into to be able to, make different moves within the real estate market.
Yeah, so if anybody has any questions about the FHA financing, because I know that's very interesting to lots of people, please drop a question in the chat. If not, we will be moving on. Our next topic is Airbnb investing. So I know a lot of people really love that in South Florida. Airbnb investing is a hot topic. You can get financing for an Airbnb property just as you would for other investment properties. Airbnb properties are pretty much very easy. You can get a lot more cap rate for your money, which is why it's very popular in South Florida, but it is like a job. So if you're looking for a low effort investing up method, that's definitely not it. It's definitely it requires a lot of risk. It has a lot more risk than regular long-term properties. It's a lot more upfront costs, because what you have to think about is not only do you have to put a down payment on the house, you also have to furnish the house. And that's what happened to me. One time I had a property that was intended for an investment property, and I midway decided that wasn't for me and that I was not interested in doing that anymore. So I had to sell off all the furniture. So that wasn't fun, but that's a lesson learned. So it's not my preferred method. I was actually just now recently thinking about doing it again, because I know, like sometimes you're in different life stages, you learn more, you think you start getting more experience. I have a lot of long-term investment properties that I like, but now I was thinking, I think personally, when it comes to Airbnb investing, it really depends on the property. It really depends on you as a person. It depends on the area very, very much. And it depends on what you're looking for, how much time you want to spend, how much effort you want to spend, how risk averse you are, because you have to think about a lot of things. There's a ton of competition, especially in Miami. There's a lot of regulations. Not every property and not every area is qualified to have an Airbnb property. And what happened to a lot of people was, for example, in North Miami does not allow Airbnb. So a lot of people were just doing the Airbnbs and starting them. And then the city came and knocked on the door and they had to close down the Airbnb. So one thing that's really, really important that you need to keep in mind when you're interested in Airbnb investing, you need to cover your bases. You need to make sure that that method is that you're really going to be able to actually do the Airbnb. And then if something like that would happen to you, would you be able to cash flow your property if the Airbnb for some reason does not work out? So cash flow, I think you guys know what I mean. It's like you want to be cash positive at the end of the day. I mean, that's most of the time the goal. So a lot of people, some people might buy for appreciation, meaning like that they're buying a property and they're hoping that it goes up in value over time. But I personally want to have cash flow, always monthly income from the property to cover my mortgage, cover some savings for expenses, and have some income, because obviously, like, I'm looking to replace my regular income. I'm looking to like gain financial freedom with that, which I think is a lot of people's goal when it comes to investing. So yeah, that's kind of like what I can say about Airbnb investing. I haven't personally done it. I do know quite a bit about it. I help investors buy Airbnb properties. I have a list of the properties that are allowed to be Airbnbs of the condos and also like single families, certain areas. And I have like a very good idea of what's a good investment when it comes to that. So if you're interested in that, definitely reach out to me directly and I can give you some more information. And Kyla, you can get into a little bit of what it takes to get financing for an Airbnb property.
Sure. So as far as financing for an Airbnb property, we don't have any loan products that are specific to Airbnb. They're not going to, a lender isn't going to consider Airbnb income as something that they're going to qualify it on. So the products that we do have are all investor products. But like I said, they're Airbnb, what your intentions are as far as Airbnb isn't going to be considered. So it's not something we would even disclose to the lender. We do have a number of products. My favorite is the Dscr product. That's like my favorite investor product that's out there. The Dscr loan product is asset-based. So this is also a great product for those of you who are self-employed and you don't like to pay Uncle Sam, so you don't claim all your taxes, which is very, very, very common, especially here in Miami. I don't think there's a single person that's self-employed that honestly states what they make, unless it's like truly something documented and they can't get away with it. And I actually did recently have somebody who provided me their tax returns, and I could tell this person really legitimately claims all of their money. God bless her. But most people do not. So the DSCR product is a fan favorite with all investors. They love it. I love it. So the way it works is the DSCR, first of all, stands for debt service coverage ratio. So basically what the lender wants to determine is if your rent that this property can rent for is going to cover your mortgage payment. And the way that is determined is what we call a 1007. We said that's a form an appraiser completes. So we have an appraiser go out and they determine what the market rent is for that property. If the market rent will cover the mortgage payment, then let's say it's 1-to-1. So let's say, just for a number's sake, your mortgage payment's $2,000 and the market rent comes back $2,000. You have a 1-to-1 DSCR ratio. Most lenders will lend up to 75%, meaning that, if the rent comes in at 75% of the mortgage payment, like it would cover 75% of the mortgage payment, they will approve it. Now, when the DSCR ratio is less than 1, meaning it's the rent does not cover the mortgage payment exactly. Now we're talking market rent. there's market rent and there's real life rent, right? So, you know, these appraisers go out and they have to get rent comps. So, which is rent comparables, just like comparable sales when you're selling a property, right? And sometimes, especially with single family homes, and Stefanie can tell you this because she's purchased single family homes as DSCR, sometimes it's difficult to find those comparable rentals. There's not too many on the market when it's a single family neighborhood, you know, for whatever reason. I know that we were really tight on ratios when Stefanie had purchased a new construction home in the Orlando area, because most of these single family homes were primary residences and were occupied. So we were relying on comparable rents, and it was difficult to find. And what we were given for an amount was actually less than what she could rent for in reality. So those are things that you have to be aware of and conversations that need to be had. I like when my investors, run properties by me, run the numbers. I'm not an appraiser, but I will do, my due diligence to kind of determine what we can get for rent. Realtors can do that as well. They have access to the MLS. They can do some research as well. I do have appraisers that I have relationships with that we talk to kind of get an idea before we go into a contract. But with that being said, the way DSCR works is you want your market rent that the appraiser determines to cover your mortgage payment, and then you're approved. Okay. They're not going to look at any of your income or any of that. They don't care. They want to make sure this investment property is going to pay for itself. Now, with these DSCR loans, the down payments start at 15%. The lower amount you put down, the higher your rate's going to be. Like, let's just keep it real. That's how they price them out. Okay. Most people put down 20%. You can go as low as 15 because, sometimes you just don't have the capital, right? You can put 25% down. You can put 30% down. You can really put down whatever you want, but they start at 15%. The rates are, Marcio and I just got a notification from one of our lenders that rates are in the 6% range for these DSCR products. Now that was, when I looked into it, it was at 30% down. And those rates also have a 5-year prepayment penalty, meaning that if you refinance or sell within 5 years, they're going to hit you with a prepayment penalty. I'll get into more detail with you on that if you'd like to reach out to me and discuss what prepayment penalties are and how they're calculated and all of that. I totally will. I just don't want to confuse people and get too into that right now. A lot of people do go with the prepayment penalties because if the rate is decent enough, like say on an investment property, you're getting like even a 7%, right? That's a good rate for an investment property. So people are like, you know what? I'll stay with that rate for the next 5 years because they know numbers wise, their property is paying for itself or cash flowing. And that's all an investor really cares about. When an investor is holding a property, they just care about that property paying for itself because they're building equity in that property over time. People who want their property to cash flow often are going towards the Airbnb side of things, because when you're doing long-term rentals, you do have to stay in line with market. And the way houses are priced right now, the property values that we have, chances are your market rent is going to pretty much cover your mortgage payment. It's going to be pretty close to even. You're not going to cash flow hundreds of dollars a month. If you want to cash flow hundreds of dollars a month, Airbnb it. That's my advice on that. That's pretty much standard how it works across the board. So yeah, we have a number of lenders that offer DSCR products. They're great. They're pretty super easy to do. And like I said, there's a variety of lenders. It really just depends, how much money you're going to put down. Obviously your credit score is a big factor there. And if you're open to the prepayment penalties, they do have no prepayment penalties as well that are available, but the rates are going to be higher. Stefanie, did you want to touch on anything DSCR since you've done a number of those yourself?
So that is my favorite type of loan. I know there's a couple of people on here that have been asking me like how I do this and what I use. So those are the main way that I buy properties and I hold them. So what I do is usually, and we're kind of like segueing into the next topic because a lot of these topics kind of overlap, or you can kind of combine these methods. So I use the Brrrr method usually, which I currently have a property under contract with hard money. So we're getting into a lot of other things now too. Okay, so what you can do is, what I do is you can either buy that's for the Brrrr now. So you can either, the Brrrr stands, by the way, for buy rehab, rent, refinance, and repeat. It's BRRRR. So that method can work if you're buying with hard money, or if you're buying with cash and then you're refinancing it into a DSCR loan, that's the debt service coverage ratio loan that we just touched on. And then you're going to hold this property most likely forever, and you're going to be getting rental income. Why would you use this method versus just buying it with a regular DSCR? So if you're just buying a property with a regular DSCR loan, one, you have to have the 20% or like 15% down at least. Two, you would want the property to already be in a good condition. So if you don't have those two factors there, then when, for example, if the house needs a new roof, the house needs considerable upgrades before it's rent ready, then you would use a hard money loan, or you would use cash if you have cash, and then you would later refinance it into the DSCR. The advantages of that are when you're doing this, and I don't know if you guys know what a hard money loan is. A hard money loan is a loan when you go to what people say is like a loan shark. I don't know how to explain it that well. It's you can get a hard money loan with less money down than a DSCR. So your entry is lower. So you can get it usually for 10%. I think that's kind of like the lowest that you can get, I would want to say. So that's a short-term loan. Yeah.
Off, but that when she says 10%, Stefanie has that because she's an experienced investor. So I want to be clear that Stefanie gets 10%, but if you've never bought and sold a property, if you've never flipped a property, that is definitely taken into consideration how much the lender wants you to put down. They want you to have more skin in the game when you're not an experienced flipper or investor, because obviously it's higher risk to them. Go ahead, sorry.
Okay, yeah, no, that's okay. I know I'm kind of like maybe going off somewhere, and maybe I lost a couple of people already on this because it's a little hard to explain. Like when you first hear about it, it's like, what are you talking about? But okay, so the whole purpose of doing these things like the refinances into the DSCR is hopefully when you're picking up this this property on a hard money loan or with cash, or actually you could maybe borrow some money from somebody to pick this up on a short-term basis, and then you're fixing it up, and then that's how you're increasing the value of the property. The whole goal is to get that money that you invested short-term back out when you have that DSCR, and then you have that DSCR in place, and then you rent this out, and that money that you use to purchase that property, you can now use this to purchase another property. So that's a method of like kind of like stacking your wealth and stacking more and more properties onto your portfolio. I hope that made sense. I hope I didn't lose too many people.
I'll also reiterate so you know that they can hear it from another perspective. So the BRRRR, the Brrrr method. I always tell people who are I think when you're purchasing any property, whether it's to live in or not, but when you purchase a property, when you're purchasing a property as an investor, you want to find something that needs work. Okay. I have the investor clients that are new to investing, and a lot of them want to purchase turnkey and they just want to rent it out. And like, that's okay. And like, sometimes it works. It's hard to find, but sometimes it works. But when you're doing this BRRR method, and if you want like a sure way it's going to work, purchase something that needs work, something that's distressed. Kitchens need to be upgraded, bathrooms need to be upgraded, flooring needs to be done. You know, the place needs a makeover. Okay. That's what you want to look for, because now you're purchasing it way under what its potential value could be if you fix it up. So this is ideal for this method, right? So let's just, for numbers' sake, say you get a house for $200,000, right? And you fix it all up. Now there's a waiting period. You have to wait 6 months to refinance. So, and this is because if it's less than 6 months, the lenders are only going to give you 75% of your purchase price. You don't want 75% of your purchase price. You want 75% of the new value that you're going to get because you just fixed it all up. You want to get all your money out of it. So the point of this method is to get all your money out of the property and like recycle it, like use it again, right? So let's say you buy a property for $200,000, right? You fix it all up, and you want to get 75% of the value. So now let's say the value comes in okay, this would be like bad numbers. Let's say you purchase it for 300,000, right? And you fix it all up. And then now it's appraising at 500,000. So when you go to refinance 6 months later and you take out 75, you can get 75% of the appraised value. You can now get $375,000, right? For that property, because it's valued at 500. So the bank's like, we'll give you 375. So you only paid 3 for it. So now you may have put some money into it, depending on how much money you put into it. Hopefully it wasn't more than 75,000. You'd be getting all of your money back out of the property, right? So now you have no money in the property. What you want to ensure is that with what your new mortgage payment is, it's going to cover whatever you're going to rent that property for. So the idea is to purchase the property at a low price. The property needs work. You fix the property up. 6 months after you purchase it, you then refinance the property. You get 75% of the appraised value. You recoup all your money. You want to have $0 left in that house when all is said and done. You want to make sure that with your new mortgage payment, your rents can cover it, or Airbnb it. If you Airbnb, you're definitely going to cover your mortgage payment. But if you're renting long term, you just want to make sure that it makes sense. The amount of your mortgage is going to be covered by your renter. And then you repeat, you take that money, you take that capital that you just invested in this home and you pulled out, and you do it again, and you do it again, and you do it again. So that way you're building a real estate portfolio. You're building long-term generational wealth. And then as time goes on, you continue to build equity in your property. In a normal market, properties appreciate 3 to 5% annually. Properties always appreciate historically. Yes, we've had market crashes. And I love when people say, well, what if the market crashes? Well, if the market crashes, guess what? You're not going to sell, because it wouldn't make sense for you to sell. So you're going to keep renting out your house. You're not going to refinance because you can't, because you would have negative equity. So if a market's down, you're just going to hold. You're going to stay where you're at. You're going to continue to live in the house, or you're going to continue to rent it out as is. You're only worried about a market crash and your property's declining if you needed to sell, or you need to refinance your home because, say, you have an adjustable interest rate. Most people today don't have adjustable rates, and people that do, they're very savvy when it comes to real estate, and they thoroughly went through their plans with their mortgage broker, or I would hope so that they know that, before their fixed term is up, that they're going to be able to refinance. You only run risk of not being able to refinance and property values declining if you're not in a fixed rate. But if you're in a fixed rate, your payment's not going to change. And then obviously, if property values have declined, you're just not going to sell. Just rent your home or continue to live in it, ride out the market, wait for it to recover, and then continue on.
Yes. So on that topic, what Kyla was just saying, you would never have an issue with that, because like she said, your rate is the same, and then your rent is either going to stay the same or it's going to get up. Actually, I have just to explain that this is a property where I use the Brrrr method, and where I have a Dscr loan. So I have a property which is a single family actually, but I split it up, which is something that you can do it in these climates to make it work, kind of like to make the rates. Oh no, did I lose you guys?
You're here. We hear you.
Okay, good. All right. So to make this work for you, because we kind of touched on that, like right now, like the interest rates are not the best. Well, there are still pretty good, but the property prices are pretty high. So kind of coupled with that, right now, we've been running into a couple of issues where lots of times, the ratio with the Dscr, like let's say like what your payment is going to be if you were to rent out a single family house, is almost 1-to-1, and nobody really wants to take on a property and rent it out with a 1-to-1 ratio, meaning that they're not going to be cash flowing at the end of the day, because that's obviously what we're doing it for, because nobody's going to put their hard-earned money into something and having somebody live there for them to not make any money off of it. So what I've found, what works pretty well for me, what I'm currently doing, what I have done before, is I'll be looking for a property, and we all know this. Everybody, if you guys are from Miami, you definitely have seen this before. Almost every property in Miami has like something that's an efficiency on the side or in the back of the yard, or if there's somewhere in the house that you can make into an efficiency if you're a little bit creative.
Every property in Miami is like, that's a single family home, is like chopped up. It's like they turn single families into 3 families. They put walls illegally, like they just cut up
Yeah. So I like to look for, when I'm looking at a property that I want to take on, I look for that. I look for, can I make more than one unit out of this? If I'm not looking for a duplex or a triplex anyways, but these tend to be a little bit expensive right now because they're obviously, this is already taken care of for you. So investors love those. The investors love the duplexes, the triplexes, and the fourplexes. So basically what I'm doing is my little secret. I look for single families where you can rent out an efficiency on the side so that you can kind of split it up. Because obviously, if you are splitting the units up into multiple units in one home, you end up usually making a little bit more in rent. So that's how I'm able to make the ratios work with the DSCRs, and that's how I end up being able to make it worth it for me to pick up properties with a DSCR loan. So I usually look for that so that I cash flow. For me, I want to cash flow at least 500 to 1,000 per property that I take on. But really for anybody, like this is like a personal preference. Like you have to decide what you want to cash flow a month, like what you're willing to put into it. And at the end of the day, everybody has a different risk tolerance, you know? So I know we had a couple of, I don't
And
know.
also keep in mind, DSCR also does DSCR cash out refinances. So if you purchase a property with DSCR and 6 months, obviously with no prepayment penalty, 6 months down the road, you can do a cash out refinance to recoup your funds that you used for the property. It's still staying within that Brrrr method. You know, if you purchased it, you know, fixed it up, and then, you know, you need to refinance. And you're one of those people who, listen, my income isn't going to work. My tax returns aren't going to work. I need it to be asset based. We do DSCR cash out refinances, and Stefanie has done those as well.
Yes, so we have a couple questions in the chat. I just wanted to touch on a couple really quickly. Somebody asked a 1031 exchange type. I think you were referring into when I got into kind of like explaining getting a hard money loan or picking up the property and then later refinancing it into a DSCR. No, that's not the same thing. A 1031 exchange is, I have never personally done one of those, but that would be something where you would sell the property that you have, and you have about, I think it's 3 months, and to find a different property that you will be purchasing with the funds that you're getting.
I think you have a year. I think you might have a year.
Oh, you have a year? Oh, I didn't know that. So yeah, so you have a certain amount of time where after you sold that property, you can then roll that into another property to avoid having to pay capital gains tax. So no, that's not the same thing that we're talking about here. We're talking about here when you're finding a property, and let's say this property is not in good enough condition to just buy it straight out DSCR. This property needs work. You might not have the funds. There are certain ways for you to pick up that property with a short-term loan and then roll that into a DSCR when you're done fixing it up. So this, let's touch on that really quickly again. So
in Florida, yeah. Sorry, in Florida, it's 180 days actually. Okay. You have to acquire another
6 months. Yeah. So you could either get a hard money loan, you could get a private money lender. This can be your mom, your uncle. This can be a friend from the street. This can be somebody that you approach to ask if they maybe have some capital that they would like to lend to you with usually pretty attractive interest rates. You just need some money. You just need the down payment money for a short amount of time. Until you can get, and then usually the rehab money also, until you can refinance this into a DSCR. So that's kind of what we were referring to here. And then I know Kamisa asked us 2 questions. Kamisa asked a question about the Brrrr. She said minimum down payment for the Brrrr is 25. No, it's 15, but usually it's 20, right?
Yeah, it really depends on your interest rate and what loan product you're using. If you're going to be using a DSCR loan product, that starts at 15%. If you're using a bridge loan, usually around 30%. If you're using hard money, that's going to depend on your experience. If you have no experience, you can plan on about 20% down. Some lenders 25, but we have lenders that'll do anywhere from like, I had an odd loan down payment amount of 7% for someone who didn't have much experience. So the lender kind of, they're private lenders. They make their own rules. You know, they look at all this criteria. But if you have no experience, you can plan on 20% DSCR 15. But yeah, it just depends on what loan product you go with, what makes the most sense. And what loan product you go with is also going to depend on what the property condition is. Like Stefanie had mentioned with DSCR, you know, there's safety and hazard issues that you can't have. You know what I mean? There's certain things that are just not acceptable with a DSCR loan. If you have a distressed property, you're going to want to go hard money or a bridge loan.
Yeah, and then like the goal would also be obviously to make that property more valuable. So when you then refinance it into DSCR, that you can then get the most cash out possible. So then you can use that cash to get other properties. So just to like kind of briefly wrap this up, I know it's not that easiest topic to understand. So for the DSCR loan, you don't have to be doing this. You don't have to get a hard money loan and find a distressed property. You can also, I've done this a couple times already before, where you just find a property that is in good condition already. Maybe it's already rented. And you can just pick this up with a DSCR loan where you don't have to, you do have to use your own credit, but you don't have to use your own income or your own taxes to qualify. This is really attractive for people who are self-employed, who have messy taxes, because most people who are self-employed have messy taxes. What does it mean when I say messy taxes? It means that we like to deduct a lot of things. So maybe on paper, we don't make as much as we really technically do, or like we're using a lot of deductions, so our income is very low on our taxes, so that we couldn't get a loan as high as when we're using the DSCR. So the DSCR is kind of a way for you to go around and to circumvent that issue with the taxes, and to just, if it's for investment purposes, to just when you're having a regular loan, you use your own income and yourself to qualify for the loan. When you have a DSCR, you're using the property to qualify. So the property has to have a certain value, and the property has to have a certain rent value to qualify. So that's kind of the difference between a regular loan and a DSCR loan. And I know Camisa had asked another question from earlier. She was asking about the Hometown Heroes project. I know it's kind of like not really investing, but I know this just popped up in the news. So the Hometown Heroes, is it the same benefits as 100% financing?
So yes, and I will talk to her off of here about that product. I do Hometown Heroes loans, so you can message me, and me and you will talk in more detail about that, because I don't want to get into that on the investor settings, because that's for primary homes.
All right. So what was our next topic? So we touched on the Brrrrs, we touched on the Airbnb and the FHA. What else did we want to talk about? We did want to mention wholesaling, even though it's kind of like wholesaling. I don't know if you've ever heard about this. Wholesaling is kind of like a method, just to briefly explain what it is, but we're not the biggest fans of it for different reasons. And I think right now it's not a really good,
not a market for it right now, is what it is, because home values are high. So
home values are high. People usually have caught on to the fact that they're high. So what a wholesaler usually does, to briefly explain it, and that's just the gist of it, is a wholesaler will find a property, usually off market meaning that it's not on the MLS, not listed by a realtor, and they will approach that person, or they will just find a person who's in distress, for example, a pre-foreclosure or like a divorce, some type of situation where there's a distress. And they will approach the person and offer them a very, very, very low number for their house to sell. And then they will act as if they're the buyer, get the property under contract, and then turn around and shop it to somebody else. And really, they're never intending on closing on that property themselves. They're intending on selling it to somebody else. So just as an example, let's say they have it under contract for $250, and it's really worth in that condition, because usually those are properties that are not fixed up. So it's probably worth in that condition maybe $30. So they will then shop it to an investor buyer. Usually it's an investor for $300, sorry. So they will have it locked up for $250 with that person who's the seller, who's in distress, and then they will take that contract and shop it to somebody and assign it to somebody. It's called an assignment. And then they will pocket the $50,000 difference. So that's what wholesaling is. I know that's a kind of like a popular investing method that's kind of like sounds really good, but it's just like
they're really acting like it's like an unlicensed realtor, like anybody can do. I can literally someone could say to me, and I've had people come to me and they're like, hey, I want to sell my house. And like people come to me wanting to sell their houses, like they think I'm a realtor, which is fine. You can, because I know realtors and I love that. So totally come to me. If you have somebody who wants to sell, let me know. But I always have, like, there's times I could have did the wholesale thing and I could have said, oh, okay, you know what, I'm going to buy the house, and I get into a contract with them and I do what's called an assignable contract, and I am looking for an end buyer. And what, the profit margin, like Stefanie said, I buy it for $250, I go and sell it for $3, I'm making 50 grand. I'm not even buying the house. I never even spent any money. I literally just got the contract and assigned somebody else as the buyer and got my money. But there's no market for that right now because property values have gone up so much. People, like, you'd have to literally live under a rock to not know that you could put your house on the market and get the most for it. So like these wholesalers were doing great for a very long time, but they're not anymore. And if you go on the internet, you see them usually selling classes on how to wholesale, because that's how they're trying to make money right now, because they're not wholesaling anything. They're just going to teach you what they did to make all the money that they were making that they're not making right now. At some point, it'll come back. The the real estate is a cycle. It goes around and around. So at some point it'll come back for them, but it won't be anytime soon. So don't buy any of those classes. Sorry, don't buy them. It's a waste of your money. And I mean, if you find somebody so you come across somebody who's like, hey, I want to sell my house, and you can find them a buyer and you want to do an assignable contract, by all means, go for it. But like, I wouldn't like make that my mission and go knocking on doors, because it sounds like it would be a lot of disappointment.
Yeah, that's basically it. So not to bash it as a whole, but it's usually a little seedy, it's a little bit lots of people I usually get a lot of emails, and those are usually properties that they have under contract, which are on the MLS, and the sellers don't know what's actually happening to them. So it's usually like it's a little borderline with the legality. So that's just so you guys know what wholesaling is. I know we have another question. What are the requirements in buying a home with an EIN?
With an EIN, Marcio, are you on? He knows all about that. Let me see where he is. He's done a lot of those EIN loans.
I want to know about
I'm
that.
here.
Hi, Marcio. Can you
Hi, how are you?
This is my partner, Marcio, for those of you who don't know. He's the best, super smart guy, and he's done a few EIN loans. Marcio, can you give any info on that?
Yeah, sure. So it's usually just buying a property in an LLC, right? So sorry, hold on one second. Just move my dog out of the way. So just buying in an LLC, it's allowed. Not much difference on the interest rate. What else can I tell you? We've done quite a few of them. They're not very difficult at all. You just need to have all your paperwork ready, like your tax ID number, your LLC set up.
Basically, commercial transaction, just purchasing in an LLC.
Yeah, exactly. I guess one of the benefits is that mortgage is then made to the LLC, so it's not going to show up on your personal credit report. So it's
similar to when our clients purchase the Dscr loans within their LLC, except it's not a Dscr product. They're able to do different loan products, but they're purchasing just the same.
Correct. Yeah. And then by it not showing up on your credit report, you have the room on your debt to income ratio to buy another one in your personal name. So
right. No liability. So that is the motivation for purchasing in an EIN, purchasing as an LLC. It's a commercial product. It's not going to affect your personal credit. So if you go and buy a primary home with a conventional FHA loan, it's not going to be considered in your debt to income ratio because it's part of your business. So this is exactly how we do the DSCR. You can buy DSCR in your personal name. That is an option, but you can buy it in an LLC, and most investors prefer to purchase it within an LLC. That's what makes the most sense.
We have another question. It says, what about the business credit and income for the business? I think they're asked, this is on that topic.
Can you repeat the question?
Okay, so what about the business credit and income for the business? I guess
So-
the EIN.
The income for your business would be determined by your tax returns, whatever you filed for your business tax return. So in a situation where you're writing everything off, you may not qualify, right? So then DSCR is going to be your product, which you'll still combine an LLC. But if you claim enough money on your business tax returns, that's when you would be using this loan product, purchasing under your LLC, but you're showing your full tax returns to qualify. Marcio, do they do it with bank statement as well?
We can do it with bank statements, and we can do it P&L too. So if we can't source the deposits for the bank statements for, whatever reason, we can't source it, or the person doesn't have an LLC, right? We have a loan right now where the client does not have an LLC. So she's self-employed, but does not have an LLC. So for her, the easiest route is just the P&L loan. We talk to the CPA.
P&L, that's profit and loss. That's something that's drafted by your CPA.
Correct. 12 months profit and loss statement drafted by your CPA.
Perfect. Thank you. And then they spoke about business credit. When we do these loans, we qualify you with your personal credit, correct? There's no business credit score. It's your personal FICO score.
Correct. Yeah, we use your personal FICO. And by the way, Kyla, obviously you know this because we do this all the time. But for those people on the call who don't know it, we can rapid rescore folks, and we also use a credit simulator. So let's say you're at 685 on your FICO, but we can pay off a couple credit cards, or even something as simple as you're an authorized user on your mom's Costco credit card, and you can take your name off of that. And next thing you know, we're rescoring, and you went from 685 to 715, and you will see a pickup of like 0.5% on your interest rate.
Right.
Or better yet is you now have gone and you've crossed the threshold where you can put less money down because now you have a better credit score.
Right. Good info. Thanks, Marcio. Any more questions?
Thank you. So yeah, just to wrap it up again. So the main ways for you to get started in investing, if you have no to low money saved up, the method of get the house hacking, which usually you can use an FHA loan. You don't have to use an FHA loan, is when you're purchasing a primary residence and it's either a single family and you're renting out rooms, if that's what you're comfortable with. That usually works really well for younger people who are single, or you can use a duplex or a triplex, and whatever the mortgage is, you hopefully will be covering some of it, or actually more than the mortgage, in with the rent from the other people who are living there. So that's a really, really great way to start. And you can actually repeat that every about year and a half, you can repeat that. So what you can do is you'll buy one, you'll live in it. You have to live in it though. That's, if you don't do that, that's not legal then. So you live in it, you live in one unit. Let's say it's a duplex to make it easier. You live in one unit, you rent out the other unit. Let's say your mortgage is $1,500 and that duplex, the other unit is $1,500 rent. So you're covering exactly your mortgage for about a year and a half. Then after a year and a half, you can repeat this process, and then you can buy another duplex, and you're now renting out the unit that you were just living in for another $1,500. So now you're cash flowing $1,500 on that property, and you're repeating this process where you're buying another property with almost no money down, pretty much no money down out of your pocket, and then you're living in it again, and then you're repeating this. So that's a really great way to build up wealth with properties. That doesn't work for everybody. People that are a little bit later in their life stage, if you have a family, that usually doesn't work that well with the numbers, but that's a great way to get started. That's if you don't have much of your own capital to start, but that's if you have a job that will let you qualify to get a personal residence that way. Or another great method is the Dscr loans, where you use the property to qualify for the mortgage. So those are basically the main investing methods that you can use to get started in investing. So yeah, I think that's it, unless Kyla wants to say any more.
want to touch on that you said, just so that people know, if you do purchase a property as primary and you occupy one unit and rent out the other, and then you move on to do that again, you have to ensure that the new property that you're buying is better, nicer, closer to work. Like, it has to make sense that you're gonna leave this residence to occupy your new one. So it wouldn't make sense if it's not as nice, you know? What would be really good, and I know we don't have as many of them in Florida, but Massachusetts and New Jersey, where I'm also licensed, is very popular 3-4 family houses. Now, if you were buying like a 4-unit property, renting out the other 3 and living in one, and then you move on to, you know, say a 3-unit that's nicer, but also buy that as primary, rent out the other 3. Then you move on to say a 2-unit that's nicer. I mean, this is an ideal situation. I mean, I'm not saying it's an easy thing to do or find, but you just need, occupancy needs to make sense. So as you purchase primary, you always need to be upgrading, needs to make more sense, where there's less units, so there's less, you have less neighbors, and that's your motivation. You have to have what the lender calls motivation to purchase as primary. Why are you vacating your current home to go to this home as your primary? Does it make sense? So that's something to keep in mind.
Yeah, so that's important. Yeah, that's so yeah, that's what Kyla meant when she says, does it make sense? It's like, does it make sense for the lender? Because the lender will be looking at that, if that makes sense, because if not, that looks shady.
Occupancy is a huge thing, because if you're not occupying it, you're a risk to the lender. That's why they want more money down, and that's why they charge more interest. So of course, everyone wants to try to purchase this primary because it's less money down, it's less interest. So the lender is very big on occupancy, and that occupancy making sense, because they're worried about risk, and of course they want their money.
Okay, awesome. Well, thank you guys so much for being here. We recorded this as always. We'll be recording this for people to rewatch. Unless anybody has any more questions, we'll be wrapping it up. We have our information is in the chat for anybody, and thank you and good night.
Thank you so much.
Thank you. Thank you. Thank you.
Bye.
Thank you.